Hello, everyone, and welcome to the morning market review. It is Monday, it's the 22nd of January 2024. My name is Russell Shaw. I'm a senior market specialist at FXCM. Just going to go ahead and bring up our disclaimers. We'll start off with the high risk investment warning. I'll keep that on screen for a few moments. If you can just have a read through that. All right, thank you very much. And let's go through and show the market commentaries disclaimer. All right, and now we'll go into our real rate, which is where we generally start the analysis. We start with the real rate. So I'll share that screen. And what we're looking for is to see if the real rate look to be toppy. It does look to have a reversal pattern in, but a top reversal pattern in, and it's reversing this uptrend. Okay, so we've looked at this previously. We've got the left shoulder here, and we've got the head over here, and we're just going to have to see how this unfolds. I took a look at the probabilities of the rate cut in March, and it's actually been priced in much lower. It's now less than 50%. It's gone into the 40%. And a week ago, we were looking at over 70%, 75% of a rate cut. Now we are, we can see that just over the last few days, that right shoulder has actually picked up. It's moved up as there was that repricing. It's kind of just over the last few days. As calendar data gets released, we'll see if the probabilities change with regards to that March rate cut. But yeah, it looks as if it's kind of been pushed off towards May. Having said that, the right shoulder does look as if it's starting to show some sort of weakness in terms of the yields. Something for us to just keep an eye on over the next few days. So Friday's candlestick looks like what we call a reference candle. It's got the highest high in at least 3 candles. And then what we want to see is if today's candlestick, perhaps tomorrow's candlestick, shows some more downside. So if we're looking, we've got 2 out of 3 conditions. We've got the highest high in at least 3 candles. Then the candlestick to the right of that reference candle is taking out its low. That's condition 2, but it hasn't closed below the low, and that's really everything. So we're still waiting to see if we get the real rate to close below Friday's low, and if it does, then potentially we have some sort of movement down here. And what's the big deal about that? Why do we start the analysis with the real rate? And just to reiterate, the real rate's a key driver. It's a key metric that's driving valuation at the moment. So we want to just keep an eye on it. It's not the only driver. We're in the midst of Q4 earnings season, so earnings are a key driver as well. But the idea here is, in terms of the time value of money, if interest rates come down, we should see stock markets getting pushed up. We should see dollar come down, and that helps with our analysis. Nevertheless, just going to go back to the fact that we do seem to have this bearish reversal, reference candle reversal coming in. And if we're getting a bearish reference candle reversal, what's it suggesting for the US dollar. So let's just bring in US dollar underneath that and see what it is we can see. So what we'll do is we'll just bring the US dollar underneath that. So let's just go US dollar, new pane underneath that. And it does seem as if we are getting some movement down. Okay, so we'll just keep an eye on it. The dollar's been quite rampant just over the last 2 weeks or so, right? A little longer than 2 weeks, and now it's coming down to test this trend line. And again, that's that repricing from a market which was effectively looking at over 70%, mid-70s in terms of a rate cut in March. Now that's gone all the way down to the mid-40s. So that's quite a big movement down. Let's go through to our weekly chart and do an analysis, and we'll do a top-down analysis. So if you take a look at the US dollar, it moved all the way back to the 30-week exponential moving average. A 30-week exponential moving average acting as resistance now. You can see the RSI hit 50. So we've almost hit a neutral reading in terms of momentum. The 30-week exponential moving average starting to flatten. If we do get some downside in terms of that real rate, it should theoretically bring the US dollar down with it. Okay. What we want to do now, just have a look at the US dollar in terms of the daily chart. Let's just bring that up. And here, what we have is the US dollar in terms of our zone analysis. It's in zone 1. So we still got an ambiguity, so to speak. So let's just understand what I mean by an ambiguity. The dollar has moved up as the March rate cut has effectively been priced out of the market, but we've still got this head and shoulders on, so to speak, on that real rate. And if that potentially completes, it breaks down through the neckline, which it should, assuming we do get the May cut, the rate cuts do start picking up. If we get data that suggests that we even get a March rate cut, it should accelerate, pull down. I think it's best actually to just have this conversation while having the up. So again, if we see the real rate complete this head and shoulders top, then I think the dollar does meet headwinds. And if it does meet headwinds, then I think that the zones, what we'll see is we'll see a change up in those zones. So we could potentially see the movement, and this is a sort of a longer term type of analysis. If that head and shoulders completes, we see it move from zone 1 back into zone 2. But the fact of the matter is, because we've got that re-rating in the rate cut for March, it's busy sitting in zone 1. It's busy sitting in our bullish area. Well, if it's sitting in our bullish area with that, well, zone 1 means any sort of dips is something that we want to see. We want to see if those are exploitable. And what we do is we'll go down to the hourly chart. And what we want to see if we can synchronize the hourly chart up with the daily chart. See if there is some sort of a dip in the uptrend here. And it does look as if we are getting some sort of support coming in. So you can see that the trend following indicators look as if they're going to, if they're crossing to the upside. Let me get that out of the camera out of the way. It does look as if we're going to get this bullish cross in the EMAs, and you can already see that the stochastic is starting to move up. So there's that ambiguity we're talking about. Long term, it does look as if we've got rate cuts ahead of us, but they've been pushed back from March through to May. We're getting that repricing the dollar's picking up. Looks as if we've got that dip in the uptrend. So that's where the time value of money seems to be rearing its head. When we take a look, say, at the S&P 500, well, let's see what's happening there, considering that the real rate is moving up. We also remember in the midst of an earning season. We're in the midst of an earning season. So what's happening is, if we take a look at the S&P 500, S&P 500 actually showing some bullishness as the earnings get released. So although one would think that the real rate should be acting as a headwind on the risk market, it's really getting a boost from the earnings at the moment. This is the weekly, so we are above that 30-week exponential moving average, and that 30-week exponential moving average pointing higher. Okay, the RSI above 50. If we go down to the daily chart for the S&P 500, what you're going to see is that it is in zone 1 as well. So let's just share up that tab, and you can see that we are between the upper red, upper blue, the Bollinger is starting to expand, and we've got the RSI above 50. So there is some sort of bullish momentum. So now a little bit of a sort of a discussion again about that ambiguity. Theoretically, one would expect the US dollar to be falling because the US dollar is a safe haven if we're getting a lift up in the risk market. At the moment, they're both getting a lift up, one getting a boost from the earnings, the other one getting a boost from the repricing and the interest rates. I don't think that's sustainable. Something's going to have to give there. So we're just going to have to watch it for the time being. Let's just go down to the hourly chart, see if the hourly chart's giving us anything in terms of the S&P 500. 500 here. All right, so you can see here was the crossover. Here was the movement of the stochastic into the upper quintile, and then we've just been hugging that upper quintile. So there's been some good upwards momentum in terms of the S&P 500. Okay, as long as it carries on maintaining in this upper quintile, we've got support for that for the S&P. So if there is a lift in gold, if there is a lift in the risk markets, let's see what gold is potentially telling us. So what we'll do is we'll go through to the gold weekly chart, see if the precious metal, the yellow metal, is helping to sort out this almost sort of confusion that's seeped into the market. So let's take a look at this in terms of the weekly. All right, gold starting to drift sideways. So again, just highlighting the lack of clear direction. Okay, so just don't have the markets moving all our own way. Why are we moving sideways? Yeah, well, it's best to see if we put in peaks and troughs. Okay, so what we can do is we can put in a reference trough over here. We can put in our reference peak right over there. Once we've got the references, you can see that there is a tendency for the precious metal to be moving up because we've got the higher trough followed by the higher peak. But where it gets a little more difficult is that we don't have a series of higher troughs followed by higher peaks. Yes, we've got the higher trough there, so we do have a series of higher troughs, okay, but after this we've got a lower peak. So that's where the ambiguity is coming in. So again, let's just understand what the ambiguity is. We've got the dollar moving up, we've got gold moving sideways, but we've got the S&P moving up as well, and that's because of the the different drivers that are having an effect in the market at the moment. The one driver is the interest rate, which should be having an effect on the risk market as well. But again, it is being overwhelmed by the fact that the earnings that are coming out are driving the market typically higher. All right. Let's see how the DAX is setting to start the morning. Okay, let's go see if there is some sort of opportunity on. Bring up the FXCM CFD here. And what you can see is we are above that 30-week exponential moving average. The 30-week exponential moving average is pointing up. We can see the RSI is above 50. What's interesting here, okay, if you take a look at this RSI, which is above 50, okay, so it's on the bullish side, it's also looking to break out now. Okay, you can see it's starting to take out this, when I say breakout, starting to move above this trend line. So that's a sort of a secondary warning saying, hang on a second, it looks as if the risk on move that is dominating on the S&P 500 looks like it's filtering in onto the DAX as well. Well, if it's filtering in on the DAX as well, let's see the daily chart and see if we can glean further information on DAX here. All right, so we'll show this in our zones. Okay, so this is DAX. Now it's in zone 2. It's in zone 2. It's in the neutral area. But what I think would be the better interpretation is it's moved from zone 3 into zone 2. So movement from zone 3 into zone 2 is relative strength forward, and not only is it moved from zone 3 into zone 2, this zone 3's support. So it's moved off of support. So what we'll do is we'll just put this order in, and you can see what we're talking about. Here's the support, and as bouncing off support, it's moved from zone 3, which is the bearish area, into the neutral area, bearish into neutral, step forward. What's happening to the RSI? RSI has popped above 50, so we are getting some bullish momentum there. Let's see if there is opportunity on the hourly chart. So let's just go ahead, bring that up. Okay, and let's share the screen here. So we've got a DAX that effectively looks like this: 1, 2, right? 2, 3. Here's the correction. It's moving back into 1, 2. Potential correction here, 2, 3. And now we've got a nice strong start to the day. Take a look at the stochastic. Stochastic's nicely above 80, so it's in the upper quintile. The EMA is starting to show that angle and separation to the upside. So as long as we hold the stochastic, in the upper quintile, I think that we would get that risk on move. So it looks as if the Q4 earnings is the key driver of risk markets at the moment, whereas the repricing of the interest rates from the interest rate cut from March through to May seems to be more what's influencing currency markets. So we'll just keep an eye on that over the next few days, see if they, instead of sort of diverging, if those two drivers start converging towards one another. So that's where we'll leave the webinar for today. Thank you very much for joining me, and please join me again for tomorrow's live stream.